In the vast realm of global commerce, Visa, Mastercard, and American Express reign supreme, each carving out its own distinct path in the financial landscape. Visa, synonymous with widespread acceptance, ensures seamless transactions worldwide, embodying convenience and security. Mastercard, with its cutting-edge technology, pushes the envelope of digital payments, offering fast, secure, and effortless purchasing experiences. American Express, the epitome of luxury in credit cards, elevates the cardholder experience with unmatched customer service and exclusive rewards. Together, these titans of the payment industry not only facilitate global transactions, but also connect diverse worlds through commerce. They are at the forefront of the digital finance revolution, shaping the future of how we spend, save, and interact with money. In an era increasingly leaning towards cashless interactions, Visa, Mastercard, and American Express are not just payment options, they are integral to the fabric of modern life, making every transaction an opportunity to explore, experience, and enjoy. The history of Visa and Mastercard is a tale of innovation, competition, and strategic evolution that reshaped the global financial landscape. Visa, originally a program launched by Bank of America in 1958, began its journey in Fresno, California. This move started with the first mass mailing of unsolicited credit cards, an all-purpose credit card program named Bank AmeriCard. The initiative represented a significant leap from the existing merchant-specific charge cards, offering unprecedented convenience and a unified financial instrument to the American middle class. As Visa's influence expanded rapidly, Bank of America had to release its direct control over the Bank AmeriCard program in the 1970s, leading to the formation of a cooperative among various issuer banks. This pivotal moment in 1976 saw the rebranding of Bank AmeriCard to Visa, symbolizing the program's growing international presence and appeal. Visa's name, chosen for its universal meaning, reflected its global aspirations. The company continued to innovate, introducing the first debit card in 1975 and going public in one of the largest IPOs in history in 2008. Mastercard, on the other hand, emerged as a direct competitor to Visa, founded in 1966 as the Interbank Card Association. It was a collaborative effort between several banks to challenge the dominance of Bank AmeriCard. Anecdotal evidence suggests that Mastercard's creation was spurred by rejection from Visa, motivating its founders to establish an alternative payment network. Visa and Mastercard soon came to dominate the market, relegating other players like Discover and American Express to smaller market shares. Initially an association of smaller regional banks, Mastercard evolved into a significant global entity, parallel to Visa's growth trajectory. Meanwhile, American Express, with its origin as a freight company, transitioned into the financial services sector in the late 19th century. It marked its entry into the payment industry by introducing its first charge card, a move that heralded a new era for the company. This diversification positioned American Express as a key player in the evolving financial services landscape. The journeys of Visa, Mastercard, and American Express illustrate the dynamic and innovative spirit of the financial services industry. From the mass mailing of credit cards to the development of global payment networks, these companies have played pivotal roles in transforming how commerce and personal finance are conducted worldwide. The credit card industry, spearheaded by Visa and Mastercard, operates on the business model that is both efficient and highly profitable. The essence of this profitability lies in its initial setup of a widespread network that connects both merchants and banks. Once this network is established, attracting new customers incurs minimal costs. This is because the infrastructure, comprising the technological and operational framework necessary for processing transactions, represents a set of fixed costs. These costs do not significantly increase with the addition of each new customer, leading to very high incremental margins for every additional user on the network. In this model, companies like Visa and Mastercard serve primarily as facilitators in the payment process. They provide the essential infrastructure, the network, that enables transactions between merchants, banks, and customers. However, these companies do not take on credit risk themselves. Instead, the issuing bank of the credit card, such as JP Morgan Chase, Wells Fargo, or Bank of America, bear the risk of non-payment and also earn interest on balances carried on the credit cards. Financial institutions such as Wells Fargo and Citibank partnered with Visa and Mastercard to issue credit cards, retaining the credit risk associated with the lending aspect of credit card usage. Meanwhile, Visa and Mastercard focus on maintaining and expanding the network that facilitates these transactions. This separation of roles within the ecosystem allows the network providers to concentrate on optimizing and securing transaction processing, without the direct financial exposure associated with credit lending. The operation of this system is based on the four-party model, which includes the payment network like Visa or Mastercard, the bank holding the customer's money, the merchant selling the product or service, and the customer themselves. The payment network works as a clearinghouse, recording transactions and tracking the flow of funds among these entities. This model has been lauded by investors like Bill Ackman, who likened owning a part of a payment network to earning a royalty every time a customer spends money, a highly desirable business proposition. Despite the apparent competition among Visa, Mastercard, and American Express, market shares have remained relatively stable over the last decade. This stability underlines the immense profitability of the business model as it currently operates. However, the advent of digital payment alternatives like PayPal and Cash App presents new challenges. These platforms could potentially disrupt the traditional network advantages by offering more streamlined digital-first transaction methods. This business model efficiency, coupled with the critical role of digital payment platforms in the increasingly online economy, underscores the dynamic and evolving nature of credit card industry. As digital alternatives continue to gain traction, the traditional players may need to innovate further to maintain their competitive edge and continue capitalizing on their network's inherent advantages. Visa and Mastercard have been leading the charge in the global payment industry, showcasing robust financial performances over the last decade. Visa, with its impressive valuation of around $540 billion, demonstrates the significant operating leverage inherent in its business model. This model allows Visa to earn approximately 25 cents for every $100 spent using its network, highlighting the scalability and efficiency of its operations. Furthermore, Visa's operating margins have been able to reach around 60%, underlining its dominance in the industry. Next, we have Mastercard, with a market cap of around $400 billion, and while slightly trailing behind Visa in terms of volume processed, has also exhibited strong financial health and growth, reaching around $25 billion in yearly revenue recently, showcasing that growth is still present despite how long Mastercard has been in business. Mastercard has found a lucrative growth path in foreign markets, reaching a staggering 13% year-over-year growth on volume in international markets as of its latest quarter, with both credit and debit making significant jumps. Last but not least comes American Express. American Express has strategically positioned itself in the industry by focusing on affluent clients who frequently spend and pay promptly. This approach has allowed Amex to deliver premium services, surpassing those of Visa and Mastercard, including exclusive lounge access, partnerships with high-profile events, and luxury services tailored for a sophisticated lifestyle. Unique in its sector, Amex combines lending with payment processing, taking on credit risk, and gaining deeper transaction insights. This enables tailored rewards and services, enhancing customer loyalty. Upon examining the data, it becomes evident that the credit card industry ranks amongst the most profitable sectors globally. This assertion is backed by sustained growth of profit margins from already substantial levels over extended periods. Despite the lucrative nature of this industry inviting competitive threats, the leading entities have effectively utilized their extensive networks and cutting-edge technological innovations to maintain their supremacy. The global shift towards a cashless society, not limited to the United States but spreading across international borders, has served as a significant catalyst, propelling the industry forward. While the future invariably holds a degree of uncertainty, the prevailing trends and dynamics suggest a highly optimistic outlook for these exceptional companies. The combination of strategic positioning, continuous innovation, and the increasing adoption of digital payment solutions worldwide underscores a promising horizon for the giants of the credit card business.